Hi, we are Kid Zaman Now Group. We're creating this video in order to fulfill the assignment project of the Warren Buffett Way book review for corporate finance class at IPMI International Business School EMBA program March 2017 class. The Warren Buffett Way has been a bestseller book for until over a decade. As per today, it is the third edition with many adjustments and updates based on Warren Buffett investment strategy.
It is written by Robert G. Hagstrom, and this third edition of the book was published on September 2013. The book consists of 320 pages.
This book explains about Buffett's investment principles, which influenced by the three people that shaped him into today's greatest investor.
Buffett said the perfect period to hold the stock is forever. Refer to compounding value of high return on equity, postponing capital gains tax, and the performance of companies positive over the time.
The first and second edition give the reader ideas on innovative investment and business strategies that Buffett implemented on his daily life.
The third edition updates readers on latest investment that Buffett made, and more important, it explains to investors on new behavioral finance so they can prepare on facing common obstacles that allowing them not to do invest like him.
Hope you enjoy it.
Warren Edward Buffett was born August 13, 1930 in Omaha, Nebraska. He was fascinated by numbers since he was born. He and his best friend used to sit at porch recording license plate numbers of the car that passed by and counting a letter appear on the newspaper as it is a secret message or secret code. Since in the early age, he used to be a good businessman. At 6, he started to sell gum, coke, soda pop, and copies of newspaper and magazines door to door. Not to mention selling corn and peanut at weekend at local football game. At age 10, his father took him to Wall Street. That is the beginning of his interest on the capital market. He explored many sources of books and newspaper in order to get as many as possible information about stock. He bought his first share when he only 11 years old, and it was a painful lesson but a valuable one. He learned one of the most important lessons in investing, which is patience. At age 13, together with his friend, they bought a reconditioned pinball machine for $25 and taking home $50 per week. When he graduated from high school, his saving was $9,000. After finishing his university, he started to reconnect again with the stock market until he found the Benjamin Graham's book, The Intelligent Investor, and makes him go to New York to study with Graham. Graham preached the importance and understanding of a company's intrinsic value. He believed investors who accurately calculated this value and bought shares below it in price could be profitable in the market. In 1954, Graham asked Warren to join on Graham Newman Company, but not for the long term. When he was 25, he started his own company called Buffett Partnership and gained $105,000 from the 7 investors, and he as the general partner only investing $100. He promised to his partners that the investments will be chosen on the basis of value, not popularity, and to beat Dow Jones by 10% points. At the first 5 years, the period Dow Jones was up 75%, the partnership gained to 151%. What he learned from Graham is, when the stock of strong company sells below its intrinsic value, act decisively. He ended the partnership on 1969 and bought the Berkshire Hathaway share. On 1985, he closed down the textile business and focused more into 2 insurance companies bought on 1967 for $8.6 million. Over the years, Buffett has added several insurance companies to Berkshire Insurance Group. The most well-known is Geico. Today, Berkshire Company is divided into 3 major groups. Collectively, this business generated in 2012 was $10.8 billion in earnings. Their portfolio of investment had a market value of $87.6 billion against a cost basis of $49.8 billion. Over the past 48 years, starting in 1965, the book value of the company has grown from $19 to $100 $114 per share. Warren is a simple person and avoids any complicated. The company that Buffett directs is the embodiment of his personality, his business philosophy, and his own unique style. For many years, people are debating about the efficient market theory, and Warren proved that the theory is flawed. Buffett became the steward of Graham's concept of margin of safety theory. But with so many new experience and failure in the real market, he starts to move away from Graham's methodology. The key lesson that Buffett took from Graham was, successful investing involves purchasing stocks when their market price is at a significant discount to their underlying business value. Other person that also influencing Buffett on his investing life is Phil Fisher. From Fisher, Buffett learned the value of scuttlebutt and not to offer stress diversification. Graham, with the quantitative analysis, emphasized factors that could be measured such as fixed asset, current earnings, and dividends. Fisher's approach is the qualitative analysis emphasized on factors that he believed can increase the value of the company, such as principally future prospects and management capability. Whereas Graham was interested in buying only cheap stocks, Fisher was interested in purchasing companies that had the potential to increase their intrinsic value over the long term. Other person that embodied Fisher's qualitative theory that also influencing Buffett's investment way of thinking is Charlie Munger. Graham gave Buffett the intellectual basis for investing and helped him learn to master his emotions in order to take advantage of market fluctuation. Fisher gave Buffett an updated, workable methodology that enabled him to identify good long-term investments and manage a focused portfolio over time. Charlie helped Buffett appreciate the economic returns that come from buying and owning great business.
When investing, Warren Buffett says we view ourselves as business analysts, not as market analysts, not as macroeconomic analysts, and not even as security analysts. He looked the business holistically, examining all quantitative and qualitative aspects of the management, financial position, and the purchase price. If we go back through time and review all the Buffett's purchases and looking for commonalities, we can find the basic principles that he has. The first one is business tenets. Buffett will not invest in a company in an industry he doesn't fully understand. He thinks that you will not be able to interpret developments accurately or make wise decisions. It is not a matter of how much you know, but how realistically you define what you don't know. He also avoids to invest in a company that has bad history and want to change direction because of their previous plans were unsuccessful. He will choose a company that has no close substitute and not regulated. He says the key to investing is determining the competitive advantage of any given company and above all, the durability of the advantage. The second one is management tenets. Buffett believes that retaining earnings in order to reinvest in the company at less than average cost of capital is completely irrational. He also respects the managers who are able to communicate the performance of their company without hiding behind generally accepted accounting principles, and those who have the courage to discuss failure openly. A good manager should be able to persuade owners to accept a short-term loss in earnings and change in the company's direction if that strategy will yield superior results over time. And the last one is taking measure of management by reviewing annual reports from a few years back, paying special attention to management and future strategy, and comparing plans to today's results. The third one is financial tenets. Buffett considers earnings per share a smokescreen. To measure a company's annual performance, Buffett prefers return on equity, owner earnings, profit margin, and the $1 premise, which is the increase in value, should match or more than the retained earnings. He also mentioned that a business should achieve good returns on equity while employing little or no debt. The last but not least is market tenets. Buffett tells us that the value of a business is determined by the net cash flow expected to occur over the life of business, discounted at an appropriate interest rate. His intention is not only to identify businesses that earn above average returns, but to purchase them at prices far below their indicated value. In his view, there is no difference between owning the company and owning a share of it, and the same mentality should apply to both. He will avoid commodity businesses and managers in whom he has little confidence. What he will purchase is the type of company that he understands, one that possesses good economics and run by trustworthy managers.
Buffett's common stock purchases have become a wonderful folklore that store unique stories behind every purchases. To fully understand his way of thinking, we can take a look at all of his common stock purchases and getting a peek at his business management, financial, and market tenets in actions. By examining the purchases of the Washington Post Company, Geico Corporation, Capital Cities or ABC, the Coca-Cola Company, General Dynamics, American Express, IBM, Heinz, as well as Wells Fargo and Company, will give you a better depiction at his thinking at the time. Each of his purchases are based on the tenets mentioned in the previous chapter. Below are the context of a few stocks purchases focusing on tenets of simple and understandable operating history and rationality. The first one is the Washington Post Company. The economics of a dominant newspapers are excellent, among the very best in the world, Buffett wrote in 1984. His grandfather once owned and edited the Coming Country Democrat, a weekly newspaper in West Point, Nebraska. And Buffett had already bought his first newspaper, the Omaha Sun, in 1969, which gave him hands-on experience in owning a newspaper business. The rationality in buying the stock comes in from the fact that the Post is the only public newspaper that is essentially debt-free, with its $50 million long-term debt was offset by its $400 million in cash. Compared to the other newspaper, the Post's changes in fundamental value is moderate. Number 2, Geico Corporation. This purchase, it was something simple and understandable for Buffett since he attended Columbia University in 1950. His teacher, Ben Graham, was a director at Geico, which made him intrigued in the company and then later bought its stocks. He continued to own and recommend insurance stocks after his first insurance purchase. And when Jack Ringwald, CEO of another insurance company that he invested in, educated him on the business for 10 years, Warren became more confident in investing. The rationality behind this purchase is he sees how Jack Barn, the newly appointed CEO of Geico, continued to show rational behavior in managing its assets. The third one, the Coca-Cola Company. The business of Coca-Cola is simple, whereby the company provides soft drink syrups and sell them to restaurants and fast food retailers, and the bottles are sold to supermarkets, mini-marts, and vending machines. Coca-Cola Company is amongst the most consistent operational business in history. The company started in 1886, selling the same product that it does now, a few hundred years later. It would be hard to name any company comparable to Coca-Cola and selling as Coca-Cola does, an unchanged product that can point to a 10-year record anything like Coca-Cola's, according to Buffett.
If you have options for different investment, Buffett would choosing to invest in stock that are produced more in the long run, more steady over a period of time, worth for your net growth of investment. This approach of focus investment entails a few of the following. Never approach the market unless you are willing to treat the stock as a part ownership in the business. In other words, think like the business owner. Study about the stock and business. Understand what is the biggest competitor, disruption, and advantage better than anyone else. Unless you are willing to invest a minimum of 5 years or even better, 10 years, then do not start a focused portfolio. Never leverage your focused portfolio. An unleveraged one will help you reach your goals in sufficient time. Accept the need to have the right emotion and personality to become a focused investor, or in other words, not a reactor to the fast-moving fluctuation in the market. It doesn't take a rocket science to become a successful investor. A simple investor miss to read up a company annual report and instead are busy focusing on the happening of the market. However, we will learn even more in the next chapter. The main key is to keep emotion in the appropriate perspective.
One of the most important elements of being successful in investing is surprisingly psychology. When it comes to investing, emotions are so real in the sense that it will affect people's behavior and reaction, and in turn will affect the market as a whole. Psychology are matter because emotions are bigger than reason, whereby fear and greed will move the stock market above and below its intrinsic value. Few characteristics has been defined and said to be deterrents of making successful investment and stopping investors from enjoying higher return. These traits include overconfidence and overreaction, loss aversion, myopic loss aversion, mental accounting, and lemming factor. However, the most dangerous one is by far the myopic loss aversion. Myopic is a medical term for short-sightedness, and this rings true to the most investors. According to analysis, the vast majority of long-term returns is only 7% of all trading months, which means the rest 93% average out to approximately zero. This data show that when evaluating performance over a short period of time will only increase your chance in seeing loss in your investment. According to Taylor and Banerjee, who coined the term, the two factors that contribute to an investor's emotional turmoil are loss aversion and frequent evaluation period. Why this is important? In order to fully understand the market, investors need to understand their own irrationalities, making the study of psychology of misjudgment to be critical. The market is volatile and will quote different under or overvalue of business and stock. It will be disastrous for an investor to fall under its influence every time. However, Warren Buffett is someone who is on other side of this spectrum, or in other words, he is rational and not emotional. He reacts differently than most and is directly at odds with existing financial theories that have been brought to students over decades. His different approach is the polar opposite of what is known as modern portfolio theory. Naturally, Buffett also takes on different definition of risk and diversification. Risk to him is linked to the investor time horizon, making any stock less risky when time of investment is extended. His unique view on risk drives his view on diversification and how he sees diversification only as average, and it's meant for people who doesn't understand business to protect their investment, as he is not at all concerned about short-term investment. Buffett has also spoken about his resistance toward the efficient market theory, or EMT, whereby theoretically, except on a random chance, no person or group could outperform the market, and he has done so in the past 48 years of his performance. Buffett's pathway is to orchestrate an investment approach that seeks to maximize on an economic risk-adjusted basis and the intrinsic value rate of growth. In summary, Buffett's success throughout his entire career has proven so many times that no one can contradict and disagree with his theory. However, most people are not able to emotionally withstand applying his lesson. People would react and fall under previously mentioned psychological traps.
Why are so many people trying to make as much money as fast they can? Is it greed or else reason? Is it mistaken belief that they can predict change in market psychological? In 1990, Shalford and Fishney wrote a research paper that comparing cost, risk, and return of short horizon and long horizon arbitrage. Many evidence shown that long-term buy and hold stock create large return. The book also explained distinguish two kind of investment ideas. First, those whose implications are straightforward and obvious take relatively little special expertise to evaluate and consequently travel quickly. Second, those that require reflection, judgment, and special expertise for their evaluation as well as consequently travel slowly. The Warren Buffett Way investment tenets are the ideas that travel slowly and that relate to the long-term business development and the basis for the long-term investing. For years, psychologists have been interested in the idea that our cognition process are divided into two models of thinking. Intuition is a produce quick and associative cognition. Reason, described as slow and rule government. Many others make decisions based on intuition thinking. The success of Warren Buffett is very much about his desire to play the game differently. It is the willingness to adopt a different set of rules. The key success and the most important from those set of rules is the value of patience. He is often called a world's greatest investor, but how do we sure? In Michael Mabusin's book, he was measured both luck and skill in business. Luck may apply in the short term, while skill apply for the long term. One of the famous principles in investing is the simple try how to be greedy when others fear and fearful when others greedy. Buffett tells us that successful investing does not require having high IQ or taking the formal course taught at most business school. What matters most is temperament. This means rationality. When Buffett invests, he sees business most investors see only a stock price. Buffett prefers to buy a business that has the opportunity to profit regardless of the economy. In his view, investment students need only two well-thought courses: how to value business and how to think about market price. In Buffett's mind, the cost of turnover is more human in nature. What we have come to understand about Buffett is that he is continually seeking patterns that can be found when analyzing business. That business pattern will at some point reveal the future pattern of the stock price. So, when Buffett purchases stock, he is focusing on two simple variables: the price of the business and its value. Throughout all the distraction in his business life, he found his niche, that point where all things make sense, where investment strategy cohabit with personality. So, our investment attitude, Buffett says, fits our personality and the way we want to live our life.